Okay,
What?
welcome, good evening. We'll start our lesson today. So we'll recap, first what we learned up to now. So what we learned during our last two lessons?
Yeah.
Anything you remember what you learned?
I know we did is it investment appraisal?
Yes. So during our last lesson, I discussed with you investment appraisal.
Yeah.
What is meant by investment appraisal? What is meant by appraisal?
Is that like the present value?
Yes, we discussed present value. Normally, what is the meaning? Simple meanings, appraisal. Why we do appraisal? Are you working?
Pardon?
Do you work?
Yeah, I work. Yeah.
You work. Okay. Your employer check your performance. Are you performing better or not? They
Did I work?
appraise you. They appraise you. Your employer. They do review your performance.
Yeah, I think they do yearly. Is it every year?
Every year. So that's your appraisal.
Yeah. Okay.
Appraisal means checking the performance, the thing we are doing, how
Yeah.
well, what are the area really we can improve it, we can appraise it. Yes, we can identify our strength, how well we perform, and which area really we need to improve.
Yeah.
So that's we learned during our last lesson. So we discussed investment appraisal during our last lesson, and we discussed appraisal. Yes.
Yes.
We discussed payback period.
Yeah.
We discussed during our last lesson NPV.
Yeah.
And I send you, we did one task as well.
Yeah. You know the task 2?
Yes.
Is that task 2.1 or 2.2?
Okay. We'll check our brief.
Pardon?
I'm going to check the brief.
Okay.
So, is a component of working capital?
It's breaking. What did you say?
Okay. So, during our last lesson, we learned about budgeting. Yes.
Hello?
Hello. Can you hear me?
Yeah, I can hear you now.
Okay. Let's just give me a minute. Just revise. Okay. Yes. During our last lesson, we did this task and we discussed it's coming level 4. Sorry, I think so is wrong, sorry, I'm looking the wrong this document, that's why the issue. So because yours is level 5, I'm on the wrong page. Okay, yours is level 5. That's why the issue there. Okay, do you have assignment brief?
Yes, in my email.
Okay, I'll look your assignment brief. Because that's the assignment brief which we discussed during our last lesson, yes?
Yeah.
And during our last lesson, we discussed about task 2,
Okay.
and we discussed you need to budgeted output,
Yeah.
1000 unit and actual output, and we discussed about the cost.
Mhm.
And that's really we need to do under the task
Okay.
2, which I explained you during our last lesson, yes?
Yeah.
So that's we discussed during our last lesson.
Yeah.
Task. Focus according to your task. So that's why I just mentioned your task during our last lesson. And okay. So yes, during our last lesson we discussed when we look yes, you're right. You're asking me about 2.1,
Yeah.
2.2 learning outcome. Assignment brief. We have a 2 documents. One is a assignment brief and one is a learning outcome which we need to. So that's your learning outcome.
Okay.
So where we discuss, we already discussed about the purpose and the requirement of financial record during our first lesson, legal requirement, type of financial statement we prepare. We discuss, stakeholders, which is main, yes, internal,
Yeah.
external. We discuss during our last lesson. We discuss about uh, according to your assignment brief, slightly is that match with 2.1. They have a set, different learning outcome. But we discussed during our last lesson, we learn about the budgeting, okay, type of
Yeah.
budgets and things. So today we are moving forward and we'll discuss working capital as well, and we'll move forward, okay. And investment appraisal we need to go through, because during our last lesson, did we didn't really calculate, investment appraisal, how we discussed the method, but we not really properly calculate, because I managed to just finish task 2 with yourself, yes?
Yeah.
Okay. So today we'll move forward and we'll go through lesson 3, and
Task
during our so we'll focus on task 3 as well.
3. Okay.
I'll show you. Okay. So today lesson we'll go through our task 3.
Mhm.
We'll start. Okay. So welcome. We'll start our lesson today. Like you very well said, during our last lesson we learned about investment appraisal. I explain you different methods we normally use to appraise, the project, wherever we'll invest, and how much we'll invest. So we discuss NPV. What is NPV stand for?
MPV.
Yes.
MPV.
It's called net present value.
Net present value.
Yes.
Okay.
Net present value method. ARR
Yeah.
is called average rate of returns.
Okay.
PBP is called payback period,
Yeah.
and IRR is stand for internal rate of return.
Okay.
So today our focus will be to go through the method. These are accounting rate of return, net present value, and internal rate of return.
Okay.
We'll go through these. First, we'll go through what's come in your mind. Payback. What is meant by payback?
When you have to pay back.
Yes, payback period. So it means how long will takes us to the money we'll invest in a business to will get back. So my initial investment, how long will takes me to cover it? So we'll go through business
Yeah.
concept, which consists of expected future income to be
Yeah.
derived from investment. With the expenditure of increasing investment, it could be used in the both profit and non-profit organization, this technique,
Yeah.
and that will help us as an organization. So investment appraisal method, these are investment appraisal method. Payback period, discounted payback. Discounted mean is the real value of money. So we can look around, if my inflation is a 3%, if we am getting £100 a year, £100 after 1 year, so what will be the value of £100 if my inflation? £100 value will be £97.
Okay.
So that's we'll go through, and net present value, internal rate of return, how much I'm expecting and what I'm getting, sensitivity analysis, how much is sensitive. We have a project, like some project is so risky, like investing in IT business, in technology business is so risky because technology is so rapidly changed. But
Yeah.
other way around is a benefit as well because we can get quicker return out of from our investment.
Okay.
Yes.
Yeah.
So that's make a difference. So let's next now. Time value of money. If I'll say to you
Yeah.
£1 now and £1 in years time, I'll say you pay me £1 after 1 year. What do you
Yeah.
think? If I'll give you £1 today and you pay me £1 back, what do you think?
Yeah.
Or you lend me £10 today and I'll pay you after 1 year £10 back. Are you happy to take £10 back?
Or £1 today.
If you gave me £10 today and
Mhm.
I will give you £10 back, after 1 year,
Yeah.
can you lend me?
Yeah.
Okay. Are you expecting more than £10 or less than £10?
No, I'm just expecting £10.
No. But because the £10 value we have it today, it won't be the same value £10.
Yeah.
Because the goods we can buy from £10 today, it won't be same goods we can buy after 1 year because there is a inflation,
Okay.
the value of the money dropped,
Yeah.
depreciate. So we need to
Okay.
look around, so we need to look the real value of the money.
Yeah.
So that's why we use, it's called discount factor,
Mhm.
discounting. So the money we have today is more worth it, the money will be in future. Yes.
Okay.
If you have
Yeah.
£100 today, if somebody say I'll pay you £100 after 1 year, so it's
Yeah.
it's a good for you to be £100 today instead of £100 after 1 year.
Okay.
So that's really is it called time value of money.
Yeah.
Okay. So first method we'll discussing is called payback period.
Mhm.
Payback period is the amount of the time taken for the net cash flow resulting from an investment.
Yeah.
So how much we invest today and how long that will cover my initial investment.
Yeah.
Your background, I think so, is a bit okay. Okay, next we're looking advantage of this method. Is it, what do you think? Is it easily understand? If you invest £100 and you cover £100, it's called 1 year to take it. To cover your investment is a very simple, very easily understandable. So it's quite good when technology is fast changing world.
Yeah.
But there is a problem with payback. It's not considered the real value of the money, because maybe the inflation is the £100 today we have, the £100 we'll get in a year's time. We can't consider how much real value will be, because money value drops so much. That's why some people keep, instead of money in a cash, they keep gold. So we need to think about, because the value of the money drops. So this method have advantages and disadvantages, like these are being discussed here. Any question?
No.
Okay. So next we moving to, we'll go through payback period method. Like if I'll invest in a business, I'll buy a machine, £60,000, and machine will produce £20,000 cash inflow for 4 years. So every year machine give me £20,000 return, and at the end of the 4 years the machine's value will be dropped to 15,000 a year for 8 years before need to be replaced. So other machine we have, that machine is a 15,000 worth, but that machine we can use 8 years. The 60,000 machine we can use 4 years, but that machine will give us. So we can calculate the payback period of these machines, so we can make a decision either which machine we'll buy. I'll give you example here. Like you invest in a business £3,100.
Yeah.
After 1 year you will get £1,000 back.
Okay.
So how much is money left to cover is £2,100 still outstanding.
Yeah.
So we can make 3 columns. One column is we write the years, one column we can write the cash flow, and one column we can write the cumulative cash flow.
Okay.
So first the money coming in a business, the money going out is called outflow. The money coming in the business is called inflow.
Okay.
So I invested £3,100 in business, and after 1 year I received £1,000 back. So my outstanding is £2,100. Then year 2 I'm getting £900 back. Then my outstanding will be £1,200. Year 3 I'm getting £800, and my outstanding £400. End of 3 years, the invested money which I invested is only 400 left to recover. Does it make sense?
Yeah.
Okay. So the following year I'm getting £500 back, but actually my outstanding were £400.
Yeah.
So if I'll calculate how many years this project or this product will recover our investment, so it takes 3 years and some months to cover my £3,100. I don't know how many months, So what I'll do, how much is outstanding? End of 3 years is a 400 left to recover, and the following year I'm getting £500. So 400 divided by 500 and times by 12. So it's give me months, So this my £3,100 will be back in 3 years and 10 months.
Yeah.
So that's only we need to calculate. This method is called payback period.
Okay.
Does it make sense?
Yeah, it makes sense.
So this is easy method. So that's why we normally use this method as a first method for appraisal.
Okay.
Then next we are using is called NPV, which is called present value method. Like during our last lesson, I have just a bit demonstrate you, like NPV, net present value. If we have a NPV positive, we accept the project. If NPV is a negative, then we'll reject the project.
Okay.
When NPV is a negative, we'll reject the project. When NPV is a positive, we'll accept the project. Yes?
Yeah.
Okay. So next we looking the question. So this method, like all other method, no method is 100% perfect. So every method have advantages and disadvantages. Yes,
Yeah.
pros and cons. So we need to look around. This method is quite good because they're looking the real value of the money. Direct link with the shareholder wealth. Shareholder mean those are investor in a business. It's consider the time value of money. Time value of money, and it's help to obsolete measure the return. It's help to measure the return.
Okay.
So, but if I'll say time value of money, is it the what is as a normal person, what's come in our mind? Time value of money, time value of money. Yes,
Yeah.
very difficult to measure the value. And I can't 100%. It's very difficult to explain you sometimes. So I'm giving you example. £100 today, the £100 you get in a year's time won't be the same value.
Yeah.
But it's very difficult. How much will be the same? How much difference will be? So we need to use some technique is called discount factor to check the real value of the money, keeping in view of the number of factors like inflation in a country, yes, wages
Yeah.
rate, national minimum wage, borrow money or not, where you get this money from or not, yes. So all these really, if you deposit money in a, how much is the basic interest rate? How much is the basic interest rate? Do you know in the UK base rate?
No, I don't know.
Base rate, recently been increased to, it used to be quarter a cent, 0.25%. The Bank of England rate is the central bank rate. That's called base rate. So now it went up to 0.5, half a cent.
Okay.
So it's increased to zero point 0.5. So now that's why the monthly payment of the mortgages went up.
Okay.
Repay because due to the interest rates change. So that's called base rate.
Okay.
So if the base rate is high, cost of capital will be high. If it's so it's very complex, this time value of money. That's why this method is sometimes is not good.
Okay.
Okay, so let's assume you're going to invest £20,000 in a business,
Mm.
and after 1 year you're getting £5,000 back, £7,000 back, £8,000 back.
Yeah.
Now I'll give you one formula which is called discount factor. So this we are looking the money we'll get after each year. It will be preset by 10%. So we use the formula which we call discount factor. So one formula is 1 divided by 1 plus r. So 1 always will keep, like number 1 is represent the year, then 1 plus r. How we can write 10%? What is meant by 10%? It means 0.1, yes? Can I write 0.1, 10%? Hello? Can you hear me? Hello? So here we'll use the discount factor. So 1 divided by 1 plus r. If you divide it, we'll get the answer 0.909. If you divide it again 1.1, then will be in year 2 0.26. If you divide it again with the denominator figures, will be equal to 0.751. So we need to add it all the, so you can do the column 2 multiply with the column 3, that's the discount factors. Hello.
Hello. Hello.
Hello. I think so. It's cut off. So what we can do, 1 divided by 1 plus r is a formula to calculate the discount factor. Normally, a table, we don't need to really, we're not appearing any exam. You need to just write the assignment and you need to understand the concept. Okay. So we need to be, if I'm doing discount factor 10%, 1 divided by 1 plus 10% means 0.1. So I can divide it, and end of 1 year I'll get figure 0.909. Okay, we are discounting. It means the year when I'll invest £1 value will be £1. But after end of 1 year, my 10% discount, if I'll do 10% discount the value, 10% depreciate of the currency, my current value will be the pound value 0.909 pence.
Okay.
After 2 years will be £1 value 0.826. If somebody, if I'll lend money to someone and someone pay me back, so every pound value will be 0.826 pence. If 10% in a year the value of the money depreciate, real value will be 82 pence. The goods I can buy 1 year before, 2 years before, £1 one, that could be cost me £1 18 pence now. So year 3, 0.751. £1 value means 75 pence will be, if I'll do rounding. So now if I'll get £5,000 after 1 year, so I can times by this factor, because the value actual will be 0.90. The 5,000 value will be £4,545.
Okay.
When you're getting £5,000, you have a note 5, yes, currency you have a 5,000, but actually when you go and buy the things, you can only buy the things which is equal to £4,545. Compared with the last year when we used to be £5,000 mean 5,000 was, yes?
Yeah.
Because due to the inflation, the value depreciate of the currency.
Okay.
Okay, then
Yeah.
next year, if you're getting £7,000 back from your investment, actually in the real value of money, you're not getting 7,000. Your actual value of the money will be £5,782. Are you getting me?
Yeah.
And year 3, if you invested 8,000, so if you're getting back £8,000, and by using this discount factor, the £8,000 value will be 6,008 pounds. What we'll do, you see their first figure, we have a negative figure. It means the money we have invested, the money went out of the business. Okay. Can we add other figures? Let's I'm going to add it. 4545 plus 5782 plus 008.
Okay.
I'm getting back 16,335 pounds after adding all these positive figures. If I'll take out the negative figures, which is 20,000 that went out of the business. Still, I am behind 3,665 pound. Yes.
Okay.
So it
Yeah.
mean my NPV is a negative. The
Mhm.
last column, if you do the total positive and negative figure, if your negative higher, we'll say we reject this project.
Okay.
If it's come positive figure, we'll say we'll accept the project.
Okay.
So that's all about the NPV.
Mhm.
So we'll do NPV. We'll do some questions. I'll try to do a bit extra lessons with you on these. Okay. Then next we have a next one. I'm using 8% discount factors.
Mhm.
So now we have. I'm going to invest 120,000. After 1 year, I'll get 50,000 pound back. After 2 years, I'll get 60,000. In third year, I'll get 80,000. In fourth year, I'll get 40,000. So now
Okay.
I'm discounting with I'm discounting by 8% every year the pound value by using discount factor by using the formula. I'll send you this.
Okay.
Sure, I send you as well, but I'll send you separate. I'll upload as well a discount factor table. So you just need to look around the rate and just I'll show you as well. Yes, rates. So you don't need to do anything else. You just need to look around the rate and the discount factors. Okay, like here, I'll give you this table. This is a discount table. So if you can't memorize the formula, what we can do, we can use this table. So if I look under 8%, yes, you see under 8%. After 1 year, this is one represent year, and there all the percentage. If I'll say 8% value drop after 1 year will be 0.926. After 2 years will be 0.857. After 3 years will be 0.794. So value drop. So now what I'm doing now, if you look here in the slide, yes, so these are all the discount factors. So then column 2 multiply with column 3 and then we'll get the figure in column 4.
Okay.
Yes, so all add positive figures, and if you take out negative figure, which is the investment, we have a positive figure higher by 70,600 pounds. So in this case, I'll accept this project because NPV is my positive. Does it make
Okay.
sense?
Yeah.
Okay, that's really two methods you need to use. I'll go through one third method as well with you. So that is called, both have a payback period and NPV. These are appraisal methods. So next method is called ARR. ARR is called average rate of return. How much average I'm getting return a year? Okay.
Yeah.
Formula average profit per year divided by the initial investment. How much money I invested and times by 100. Like if I'll go through this with you,
Mhm.
like ARR for all three projects. We have a three project: Handover, Bristol, and Carlisle. These are the project names. And first project I'll invest 4 million. Second project I'll invest 4 million. And the third project required. Each year, first project give me 1 million back, 1 million back, 1 million back, 1 million back. But project B will give me 1.5 million back in year 1, 2.5 in year 2, and year 3 will give me zero point 0.5, and year 5 give me nothing out of any return. Carlisle, it gave me nothing in a year 1. Year 2 will give me 0.5 million back. Year 3 will give me. So what I'm going to do, you add them all, whatever return. If you add them all, the first one, 1, 2, 3, 4, 5. Yes. In 5 years, I'm getting 5 million back. So how much is the profit? I invested 4 million. I'm getting back 5 million. So 1 million is a profit. Make
Yeah.
sense?
Yeah.
In project B, Bristol, 1.5, 2.5, that make 4 million,
Mhm.
4.55. So in 4 year, I'm getting 5 million divided by 5. My average profit is, my total profit is 1 million.
Okay.
Year 5, Carlisle project, how much is 5 million I'm going to invest? 0.5 I'm getting, 1.5 I'm getting is mean 2 million, 2 million, 2 million, 4 million I'm getting 5 million. So 3 is make me 5 minus 7 give me 2 million profit. So first project give me 1 million, second project give me 1 million, third project give me 2 million back, but it's required 5 million investment. Okay, this money which I'm getting 1 million back in how many years? 5 years. So I'll divide on 1 divided by 5. It's mean average my profit is 0.2 million each year. Project, the third project Carlisle, I'm getting 0.4 million. So if I'll calculate the percentage, now I have average profit 0.2 million. How much I invested? 4 million. 0.2 divided by 4 times by 100, it's mean I'm getting 5% profit a year. This project give me 5% profit, and project C will give me 8% profit. So which project you think is better for us to invest money?
Carlisle. What's that? The
I guess
third one.
you're right. Carlisle is best. What is the problem with Carlisle?
So the problem.
Yes, is there any problem? Only problem is required 5 million to invest.
Oh, okay.
Other required 4 million. If I don't have a 5 million, I will go for then B.
Okay.
So that's really only the problem is required more investment.
Yeah.
But it give me high return. So this is all the question. Okay. And the payback period we can calculate by using the payback period method. Like all these are the question I just added extra. Okay. So you don't need to too much worried. You can try. Yes, by looking the question 1 which we solved. Can we do a bit quiz?
Okay.
You can try your own. Okay. We'll go through next question and then we'll do the quiz, during our next lesson then. Okay, break even. Have you heard break even? What is meant by break even?
It sounds familiar, but I can't remember.
Okay, break even is a point where no profit, no loss.
Okay.
A point where no profit, no loss. So this is called break even. So it's very popular. It could be help company calculate the break even point. It help to decide, and we can investigate the how much is the sales value and profit. Break even is a point where these cost is equal, fixed and variables, and if that's a point where are, so we can calculate the break even. We'll do break even formula: fixed cost divided by contribution.
Yeah.
And the contribution is always comes selling price minus variable cost. Okay, we'll go through the question here. We have how much is the selling price? 12. And cost me variable cost, the cost will change with the output. That's 3. So my contribution will be 9. But my contribution will be 9.
Yeah.
So 45,000 divided by 9. What will be break even? What figure will come? 49 divided by 9.
Let me see. Hold on. 49 divided by 9.
Yes.
That'll give you 5.4.
No. Let's 45,000 divided by 9.
45,000 divided by 9. That gives you 5,000.
5,000.
Yeah.
So to be break even, so my break even will be on 5,000. Yes. So
Yeah.
I need to be sell 5,000 units. Then there will be no profit, no loss. Can stay in a business. I'll meet my cost. Make sense?
Yeah.
Okay. So that's way we can. I'll just keep up to here. I'm not going next element. Okay. So
Okay.
break even. Break even is mean selling price minus variable cost, and you get the contribution, and fixed cost divided by contribution. It'll give me break even, and that point is called break even in units. We can calculate it. Okay.
Okay. Yeah.
This level you just need up to there. And we'll go through during next lesson or further. Okay. One is called working capital. Have you ever heard working capital?
I don't think so, no.
Okay, working capital mean the running capital in a business, which is normally our receivables and our payment, our stock. Those are come under working capitals.
Yeah.
So during our next lesson, I'll go through working capitals, and our further we maybe need to do 1-2 lessons extra for this unit to cover every bit and pieces.
Okay, you know the guidelines. Can you go to them again, please?
Which one? This one?
No, it's not. Is this the one? Oh, is it this one? I think
Yes.
it's this one. Yeah. Okay, so the task 2, I've done that. We've done that one, right?
Yes, we did together. Yes.
Okay, so where's the next one? Task 3.
Yes.
I'll be doing this next lesson.
Task 3 is all about your investment appraisal, like I discussed. How much I'm going to invest project. I have 2 project, 1 and 2. So first one we are going to invest 200,000. How much we are getting? You can make 3 columns. Yes, 1, 2, 3. After
Yeah.
1 year, I'm getting 5,000 pound, 58,000 pound back. Year 2, I'm not getting anything, even is a loss. And year 3, I'm getting 1,000.
Okay.
Yes. So we need to, what we need to calculate, if you go back to, so we are using 10% discount factor table. I said I'll send you the table as well. So then we can calculate the payback period and net present value. Okay. And the third method we can just only calculate, I can explain you third as well. We don't need, so we'll go through next lesson. I'll calculate for you. Okay. Do
Okay,
calculation.
Can you send this to me, please?
Which one?
Can you send me this guideline, please? I don't
Yes,
have it.
no problem. I'm going to send you.
Thank you.
And then we'll go through. As you have only 3 tasks in your assignment.
Yeah.
1, 2, 3. Yes, that's cover everything. So it's cover. First one is cover your 1.2, 1.31. Yes, you see there are learning outcome. Second is covering 3.3. Fourth is covering 4.1, 4.2, 4.3, 2.1, and 2.2. That's why, because we follow the assignment brief, and that's why our the learning outcome is not matching with it. Okay. So, but we'll cover everything.
Okay.
Any question?
No, thank you.
So, yes, I'll send you, and during our next lesson we'll do activity. I'll sort
Okay.
out, I'll do myself, I'll show you, and you can
Mhm.
use it, as well.
Okay then.
Okay?
Thank you. So when is
Have
our
a
next
good,
lesson?
sorry?
When is our next lesson?
Next lesson we'll do same time next week.
Next week Friday. I start work at 6 o'clock in the evening.
Okay, no
So
problem. If you want me, I can do Saturday with you.
Saturday. Let me check if I'm working.
No problem. Just let me know.
Okay.